Welcome back to the deep dive. Today, we're really aiming to cut through the noise, all the chatter about market volatility.
And pull out something genuinely useful, some real wisdom.
Exactly. We have a very focused mission, actually. We want to explore that crucial difference between, let's call it a lucky break,
Right, to cuddle May.
and an investment strategy that's actually built to last, something sustainable.
And we're using a pretty stark case study to make the point, aren't we? We're diving deep into the story of Nam. He's a new investor, what people often call an F0 investor.
Yes, the F0.
And he basically learned the most expensive lesson Wall Street can teach, all crammed into one really, really bad Friday session.
That's right. Our sources, they detail his personal Black Friday, October 10th. And it's this perfect storm, really, of global geopolitics colliding with domestic instability.
Yeah, and it just annihilated his portfolio in real time.
So we're going to break down that day almost minute by minute. We want to pull out the concrete lessons, maybe the painful ones, so that you, listening, can hopefully build some resilience, maybe avoid making those same mistakes.
And what makes this case study so important, I think, is that the crash wasn't about bad earnings calls or, weak balance sheets from the companies he owned.
Yeah, not at all.
It was purely driven by these bigger forces, macro forces, political gamesmanship, even commodity weaponization, things that Nam, frankly, like a lot of new investors, just sort of waved away as too far off to matter.
Okay, so let's set the scene then. Picture this. It's Friday morning, October 10th. Nam's feeling pretty good.
On top of the world, probably.
Yeah. He's got his coffee, watching the screens, everything's looking green. He feels, invincible. And he has this very specific goal in mind.
Yeah, Tesla.
The Tesla Model 3. He figures he just needs, 5% more profit, just 5% more, and he can put down the deposit. It's almost within reach.
And that goal, it really fueled his whole philosophy, which was, honestly, incredibly dangerous. Kumalatin.
Just buy and win.
Just buy what's hot, ride the momentum, and victory is yours. The irony is just palpable, isn't it? He's dreaming about this high-tech electric car.
Right.
Totally oblivious that the very global supply chain that makes that car possible is about to be turned into a weapon against his own money.
So let's dig into that mindset first.
Yeah.
The psychology behind that confidence. Because Nam, he really embodies that bull market investor, the one who thinks luck is skill. Tell us a bit more about this F0 mindset.
Sure. So Nam was a genuine F0.
Yeah.
And for anyone listening who isn't familiar with the term, an F0 is basically the newest kid on the block in retail investing.
Right, a freshman class.
Exactly. Someone who probably started trading during a long bull run, maybe the one after the pandemic dip, and they've just never seen a real prolonged downturn or even just a sharp, nasty correction. They've got this sort of financial innocence, usually jumping in when things are already frothy.
And Nam fit that profile. He'd only been investing in the U.S. market for just over a year, but wow, what a year it had been up to that point.
Oh, absolutely. He'd seen success, right? Easy success. And crucially, he thought it was all down to him, his own genius.
Felt like a Wall Street genius, the sources say.
Yeah, after reading maybe a couple of popular investing books, watching some YouTube channels. But the real confidence wasn't from knowledge. It was from the market, just constantly rewarding him, his strategy. Dead simple. Buy the stocks everyone's talking about, the ones with the most hype, the highest momentum.
Which back then meant tech, and more tech. NVIDIA, AMD, Tesla, the absolute darlings of that market phase. Huge momentum, feeding huge optimism.
And this brings us to a really critical point about how markets can condition investors. Every single time the market took a little dip, a buying opportunity, as they like to call it.
A sale.
Yeah, exactly, a sale. It just bounced back stronger, often really quickly. And this just hammered home what the forces call his iron belief.
Which was?
That the market only goes one way, up, always up. And it's this lack of historical perspective, this recency bias, that creates such profound vulnerability.
That's such a classic trap, isn't it? The market keeps rewarding you for taking more risk, so you just stop seeing any reason to play defense. It becomes this self-feeding loop. Positive reinforcement leads to bigger bets, more concentration.
Precisely. So while Nam's scrolling through pictures of Tesla interiors, laser focused on that down payment, the actual threat, the real danger, is already taking shape.
But it's happening thousands of miles away, seems completely disconnected from his NVIDIA stock price.
And that's where we pivot next. The fuse being lit, quietly at first, the rare earth warning. It didn't start with a bang. It started with these little headlines, things Nam, and honestly, probably a lot of people just glanced at and dismissed.
What was the headline?
Something like, China tightens control of rare earth exports. Pretty dry stuff on the surface.
I remember reading his reaction in the source material. He apparently scoffed, thought rare earth sounded like something out of a video game.
Right. He sort of knew they were used in tech, chips, phones, whatever. But his immediate take was, oh, it's just some political posturing way over there. How could that possibly hurt my booming American tech giants?
Sure.
Big mistake.
Huge. And this is where we need to get specific because rare earth sounds vague, but the actual elements are critical.
Absolutely critical. We're not talking about just any metals. We're talking about things like neodymium. You need that for the incredibly strong magnets in EV motors, like in his dream Tesla, and also in hard drives.
Oh, okay.
Then there's dysprosium, which is vital for making sure those magnets work properly when they get hot. And elements like lanthanum, used in making advanced semiconductors, the very heart of NVIDIA and AMD chips, and also in things like high-tech camera lenses.
So these aren't just minor ingredients, they're foundational, irreplaceable in many cases for the kind of high-performance tech he was invested in.
Exactly. The bedrock. And China's move, it wasn't just a vague tightening. It was incredibly specific, almost surgical and aggressive.
What was the specific mechanism?
So, the day before NAM's Black Friday, Beijing formally announced this new rule. Any product at all containing even 0.1% of Chinese rare earth value now needed a specific government license before it could be exported.
0.1%. That's almost nothing. How could you even track that reliably in a complex global supply chain?
You probably couldn't easily. And that's the point. It creates maximum uncertainty, maximum bureaucratic friction. It essentially turned this vital resource into a potential choke point, controlled by Beijing, aimed right at the core of global tech manufacturing.
It's basically saying if even a tiny screw deep inside your complex machine relies on a process using a pinch of our rare earths, your whole product might get blocked. That's immense leverage.
Immense. But what's fascinating looking back is how the market initially reacted, or rather how it didn't react strongly. There was a sense of complacency.
Really, despite the potential impact.
Yeah, the chatter among many analysts, the general consensus was kind of optimistic. You heard things like, oh, they'll negotiate soon. There's this posturing before the Apex summit. It's saber rattling. That optimism created this false calm right before the storm hit.
And the thing that shattered the calm wasn't a formal diplomatic note or some press conference from the White House briefing room.
No, nothing like that. It was much more modern, much faster, and driven by personality.
Which brings us to that moment, the cataclysmic post.
Right. So the U.S. market opens on Friday morning. For a few minutes, things look okay. The main indices are actually up slightly. NAM must have felt vindicated, right? Thinking, see, that rare earth stuff was nothing.
The calm before the tweet storm.
Precisely. The calm lasted only minutes. Then the shockwave hit, not from an official channel, but directly from President Donald Trump's account on Truth Social.
Cutting out the middleman, straight to the market's nervous system.
Absolutely. The post was an immediate, unfiltered escalation. It stated two things very bluntly. First, the planned meeting with Chairman Xi at the APEC summit in South Korea, just 2 weeks away, was now likely off.
Okay, that kills the negotiation hopes right there.
Instantly. And then the second punch, one policy actively being considered was hitting Chinese goods coming into the U.S. with large tariffs.
We need to pause on tariffs for a second. Because for a new investor like NAM, maybe you hear tariffs on China and think, okay, that's a tax on them. But that's not really how it works, is it?
Not at all. You've hit the crucial point. A tariff is technically a tax paid by the importer, the American company, buying the goods from China. And where does that cost inevitably go?
Straight to the U.S. business or the U.S. consumer. It's effectively a tax increase on Americans.
Exactly. So the market freaks out for two big reasons. One, tariffs choke off Chinese exports, which obviously hurts companies relying on China for manufacturing or sales, think Apple, or indirectly, the companies making components for them, like NAM's tech stocks.
Right.
But second, and this is huge for the U.S. economy itself, it acts like a massive brake. It raises costs for American businesses, raises prices for consumers, slows down spending, and makes everyone slash their forecasts for economic growth.
Yeah.
It's a lose-lose for the global economy.
So when that post landed, NAM literally watched his screen bleed. Those lovely green numbers just instantly flipped, surged into this aggressive, flashing red.
Yeah. The Dow, the S&P 500, and especially the NASDAQ, where his bets were concentrated, they just started falling fast. An uncontrolled slide. It must have felt like the floor just vanished.
And the violence of that reaction, it was because the post didn't just add risk. It fundamentally dissolved the market's core assumption, didn't it? The assumption that cooler heads would prevail, that a deal was still possible.
Completely evaporated it.
Yeah.
And any lingering hope was crushed by Trump's follow-up posts. He explicitly accused China of playing the rare earth card to make things difficult. This confirmed it wasn't just talk, it was a direct confrontation. The trade war wasn't just looming anymore, it was here.
And this is where raw emotion takes over. Panic sets in. The source material quotes Jeff Kilberg from KKM Financial, summing up the mood perfectly. What did he say?
He said, investors are locking in profits aggressively.
Locking in profits. That phrase really highlights the difference between the pros and someone like Nam, doesn't it?
Absolutely. If you're a big fund manager, maybe you've held Apple or Nvidia for years, you actually have profits to lock in. You sell some winners, reduce your risk. But if you're Nam, an F-Zero who bought near the top just months ago.
You have nothing to lock in.
Exactly. All you have are losses. Yeah. Losses that are getting bigger by the second. And you're facing this horrible emotional decision. Do I sell now and make the loss real? Or do I hold on, pray for a bounce, and risk losing even more? It's the speed of the loss that just shatters your confidence.
And that panic wasn't just a feeling. It had numbers attached. Cold, hard metrics that define Nam's Black Friday.
Yeah, let's look at those. To really gauge the fear, the psychological shift, you look at the VIX, the volatility index.
Wall Street's fear index.
Right. And after basically 4 months of being pretty sleepy, what the source is called hibernation, the VIX just exploded upwards. It surged past a really key level, the 22-point threshold.
Okay, let's unpack that. Why 22? What does the VIX actually tell us, and why is crossing that number such a big deal?
Good question. The VIX isn't measuring the price of stocks. It's measuring expected volatility. It's calculated from the prices of options on the S&P 500 index. Basically, it reflects what the market thinks the range of price swings up or down will be over the next 30 days.
So a low VIX means the market expects calm seas.
Pretty much. Like if the VIX is down around 12 or 14, it signals complacency. Yeah. Low expected turbulence. Smooth sailing ahead, supposedly.
So hitting 22 is like the storm warning siren going off?
Exactly. It's a panic button. Historically, when the VIX crosses 22, it signifies a shift. You're moving out of that sort of medium volatility, general complacency zone and into high volatility territory, what traders just call fear. It means the market is suddenly pricing in big, unpredictable moves. That single Friday, the consensus flipped from everything's fine to batten down the hatches.
And the closing numbers certainly reflected that fear. When the bell finally rang, brutal, the Dow Jones Industrial Average lost 878.82 points. That's a 1.9% slide in one day. Just massive liquidation.
And the broader market, the S&P 500, it got hit even harder in percentage terms. It lost 2.71%, closing down at 6,552.51. And the sources make a really important point here.
Which is?
This was the worst single day for the S&P 500 since April 10th. And guess what drove the market down on April 10th?
Let me guess. Tariffs.
Bingo. Another Trump tariff plan. It just underscores how tariffs have become the dominant short-term risk. Forget earnings, forget fundamentals for a moment. It was all about trade policy risk.
But the real ground zero for Nam, the place where his portfolio felt the most intense pain, was the NASDAQ.
Oh, yeah. The NASDAQ Composite, home to all those high-flying tech stocks he loved, it plummeted 3.56%, closed at 22,204.43 points. For someone like Nam, who was all in on the idea that tech always leads the way up, this wasn't just a loss, it was a demolition.
A complete wipeout. All the gains he'd maybe made earlier in the week, gone. Vaporized in a few hours of Friday trading. The source narrative puts it starkly. His dream of that Tesla suddenly felt as far away as the distance from Earth to Mars, just evaporated.
And just when you thought it couldn't get worse, the final blow came after the market closed.
Right, the after-hours post.
Yeah. If anyone was clinging to the hope that maybe Friday's panic was an overreaction, that maybe things would calm down over the weekend, President Trump posted again on Truth Social. And this time, it wasn't just large tariffs. He threatened an additional 100% tariff on Chinese goods.
100%. That's not a tariff. That's basically an embargo.
It's punitive. And he put a date on it, effective November 1st. This wasn't a warning shot anymore. This was confirmation. Any hope of reconciliation, any chance of dialing back the tension before APEC, completely gone. It guaranteed the next week would start in turmoil. The trade war was on full blast.
That market plunge was just vicious. But it wasn't only about the trade war, was it? What really seemed to pour gasoline on the fire for Nam, and what we dig into next with the domino effect, was the stuff happening right here at home in Washington.
Absolutely. It shows how these external shocks can combine with internal instability to create something much worse.
Let's start with the tech stocks themselves. Nam was all in, and that was his Achilles heel. Art Hogan, a strategist quoted in the sources, really nailed why tech gets hit so hard in these situations.
Yeah, Hogan's insight was critical. He pointed out that big tech companies have this double vulnerability to China. It's not just one thing. First, it's manufacturing, the supply chain dependency, the rare earths we talked about, assembly lines.
Right, getting things made.
And second, it's sales. China is this enormous, absolutely critical market for selling iPhones, Teslas, high-end chips. You can't easily replace those hundreds of millions of consumers. So tech stocks become hostages in this geopolitical fight, squeezed from both ends.
And the numbers for Nam's specific holdings really showed that pain. NVIDIA, down 5%. AMD hit even harder, down a nasty 8%. And Tesla, his big dream, down a painful 5% too. His genius strategy of just buying the winners suddenly looked like a very concentrated, very vulnerable bet.
But the market wasn't just dealing with the China fallout. At the exact same time, compounding the fear, was this paralyzing situation in U.S. politics. The U.S. government was, believe it or not, in its 10th straight day of shutdown.
10th day. Because the political parties couldn't agree on a budget. Basic government functions grinding to a halt.
Right. And why does a government shutdown freak out investors? It's not just the bad optics, though. That's part of it.
It's about information, isn't it? Data flow.
Exactly. Investors, especially the big institutions, the quant funds, they rely on a steady stream of economic data from government agencies. Think Bureau of Labor Statistics for jobs numbers, Census Bureau for retail sales, Bureau of Economic Analysis for GDP.
Consumer confidence numbers, inflation data like the CPI, durable goods orders, all that stuff just stops coming out.
It dries up. The government agencies responsible for collecting and releasing it are literally shut down.
Yeah.
So the market, which is already panicking because of the tariff bombshell, is now suddenly flying blind. The flow of reliable economic information just ceases. That vacuum of data injects massive uncertainty.
And the political signals were terrible, too. The Senate had failed, the 7th time to pass even a temporary funding bill. Just complete gridlock.
Yeah. And investors looked at that and thought, okay, Washington is completely dysfunctional. They can't even keep the lights on. How are they possibly going to manage a complex global economic crisis triggered by a trade war? It just shreds confidence in U.S. leadership and, by extension, U.S. assets.
And there was official confirmation of the real-world impact, too. Russell Vought, the budget director at the time, actually confirmed that federal employee layoffs, they weren't just threatened, they had begun.
So imagine being Nam. You're caught in this crossfire. Your tech stocks are getting hammered by the trade war from outside. And simultaneously, the stability of the whole U.S. economy is being undermined from within by political paralysis. Nowhere feels safe.
And the ripples didn't stop there. The fear spread like contagion, didn't it? It jumped from stocks straight into the energy markets.
Immediately. Commodity traders didn't need complex models for this one. The logic was brutally simple.
Trade war between U.S. and China, the world's two biggest economies.
It means global economic growth is going to slow down, probably sharply, and if growth slows.
Less manufacturing, less shipping, less travel, less demand for energy, oil.
Exactly. Andy Lippo from Lippo Oil Associates spelled it out in the sources. When there are actions and counteractions like this, the oil market will interpret that oil consumption demand will slow down or even decrease. Simple cause and effect.
And that fear showed up instantly in the price. Brent crude, the main international benchmark,
took a nosedive, fell $2.49 a barrel. That's a 3.82% drop in one day, hitting its lowest level since early June that year.
And WTI, the U.S. benchmark.
WTI, West Texas Intermediate, got hit even harder. It fell $2.61 a barrel, which was a 4.24% drop.
Why the bigger drop for WTI usually? What does that signal?
Well, Brent often reflects more of the global picture, things like OPEC decisions or tensions in the Middle East. WTI is more closely tied to North American supply and demand, particularly the storage levels at Cushing, Oklahoma. So when WTI falls hard as on Brent, it often suggests the market thinks U.S. demand specifically is going to take a particularly big immediate hit, which makes sense given the trade war escalation and the domestic government shutdown happening simultaneously.
And adding to the downward pressure on oil, there was actually some good news from somewhere else entirely. How did a ceasefire in Gaza factor into Nam's tech portfolio collapsing?
It seems unrelated, but it connects through something called the geopolitical risk premium.
Okay, explain that.
There's almost always a bit of extra cost built into the price of oil, especially Brent, that reflect the risk of supply disruptions, particularly from the Middle East. Political instability, conflicts, anything that might interrupt the flow of oil adds a premium.
So when the ceasefire between Israel and Hamas was announced,
Even though the situation remained tense, that specific immediate risk of a wider conflict disrupting oil supplies went down slightly. So that risk premium came out of the price. It provided another reason for oil prices to fall, contributing to the overall bearish mood.
and this happened just as oil markets were already dealing with oversupply issues, right? OPEC Plus kept raising production.
Exactly. So you had falling demand expectations because of the trade war, plus reduced geopolitical risk premium because of the ceasefire, plus existing abundant supply. It was a perfect storm pushing oil prices down hard.
This whole cascade, it must have been the moment the light bulb went on for Nam, the painful realization of how everything is connected.
You have to think so. He saw firsthand that the financial world isn't siloed. It's this incredibly complex, interconnected system. A single tweet from the US president, a policy decision about obscure metals in China, a failed budget vote in the US Senate, a ceasefire halfway across the world.
All converging to create this tidal wave that swamps his specific tech stocks.
That's the core lesson, isn't it? The global economy is like, as the source puts it, a living body. An illness in one part, whether it's a blocked artery in the supply chain, a political fever, or even just reduced stress in one region, it affects the entire system. It doesn't matter if you think your investments are safely tucked away somewhere else.
Wow, that is one expensive education, paid for in cold, hard cash from his brokerage account, which leads us straight into the lessons learned. Nam lost a lot of money, sure, but the sources suggest he gained something arguably more valuable.
Perspective.
Yeah.
Humility, the kind of understanding you just can't get from a book or a YouTube guru. The market itself taught him.
Okay, lesson one. Seems fundamental, but clearly easy to forget in a bull run.
The two-way street. Simple as that. The market isn't a magical escalator designed solely to make F-Zero investors rich. It goes down too. And it often reverses direction violently, brutally, usually right when everyone feels the most confident, the most complacent.
Yeah, realized his earlier success wasn't skill, it was just riding a wave. His confidence was subjective, emotional.
And subjectivity, the source's stress, is where loss begins. Believing it can only go up is setting yourself up for disaster.
Lesson two feels incredibly relevant right now, maybe more than ever.
Geopolitical risk is real and immediate. You absolutely cannot ignore the big picture anymore. Nam dismissed the macro news, the trade tensions, the rare earth politics, even the domestic shutdown as just background noise. Too far away, too complicated.
Big mistake. He learned that a political butterfly flap, like that Truth Social post or resource decision in Beijing, can trigger a global financial hurricane that lands right on your portfolio, even if you own purely domestic stocks.
It fundamentally changes what investors need to track. It's not enough just to look at price-to-earnings ratios anymore. You have to stay current on trade policy, on potential supply chain choke points, on what governments and central banks are doing, because these factors are now major sources of systemic risk that can just overwhelm company fundamentals.
Lesson three. This one's timeless. The cardinal sin Nam committed.
The danger of all in, putting all his financial eggs in one single basket. And not just any basket, but the highest flying, highest risk sector tech, which also happened to be the most vulnerable sector to the specific threat of a US-China trade war. He had zero defense, zero diversification.
So the takeaway isn't just diversify, it's diversify meaningfully.
Exactly. It's not about owning 5 different semiconductor stocks. It's about spreading your capital across fundamentally different areas of the economy. Maybe some finance, some consumer staples that people buy regardless of the economy, some healthcare, maybe some energy, and crucially, thinking beyond just stocks, bonds, gold, maybe real assets. Diversification isn't really about chasing higher returns. It's about survival. It's about making sure that when one part of the system gets hit hard, like tech did for Nam, your entire financial life doesn't collapse.
And the final lesson, perhaps the hardest one to swallow, especially after feeling like a genius.
Humility trumps genius.
Ouch.
Nam had to face the fact that his early wins weren't due to his brilliance. They were mostly luck, good timing, riding a powerful bull market wave, that brutal Black Friday loss. That brought him crashing back to reality.
Forced him to admit his knowledge was shallow, that he needed to actually learn, continuously, objectively.
Right. The market has a way of humbling everyone eventually. It rewards preparation, discipline, and respecting risk far more than it rewards reckless optimism or thinking you've cracked the code after a few good months.
Okay, so let's boil this down. NAM's painful experience gives us some really clear, actionable takeaways. Things you, listening right now, can apply, whether you're an F0 or you've been investing for years.
Absolutely. Let's make this practical. Takeaway number 1, always update macro information.
Meaning look beyond the stock charts.
Way beyond.
Yeah.
You need to actively understand the bigger picture. What's happening with interest rates globally, where are the trade negotiations heading, what commodities are becoming strategic choke points like rare earths were here. Knowing the context helps you anticipate risk, not just react after the price has already moved.
Okay, makes sense. Second takeaway.
Define a discipline plan. This is crucial. Before you buy anything, you need to be able to answer some tough questions. Why am I buying this specific asset right now? What fundamental or technical reason? Second, under what conditions will I sell it, both for profit and, more importantly, for a loss? What's my target and what's my absolute pain point?
The cut-loss point.
The non-negotiable cut-loss point. You need predefined rules, objective analysis guiding your actions, not gut feelings, not hope, not fear. Discipline.
Which leads directly to the third takeaway. Manage emotions. Because NAM's story is a perfect example of how emotions hijack decision-making.
It really is. The stock market fundamentally is a psychological battlefield as much as a financial one. You have to cultivate a cool head. Avoid getting swept up by greed during a rally. That's when people over-leverage or chase stocks they don't understand.
And crucially, avoid panic selling right at the bottom when fear takes over during a crash. Easier said than done, of course.
Much easier said than done. But acknowledging the battle is the first step. There's that phrase Nam learned the hard way. Kilut kamsuk.
Discipline is greater than emotion.
Your plan, your rules, have to be stronger than that immediate urge to panic or chase.
And one final, really critical point, especially aimed at newer investors like NAM was.
Yes. Avoid leverage. Avoid margin, please. For anyone new to investing, just don't do it. Margin trading, borrowing money to invest, it feels great when the market's going up because it magnifies your profits. But it magnifies your losses exponentially when the market turns against you. What could have been a manageable, painful loss can become an account-destroying catastrophe very, very quickly. NAM, thankfully, wasn't fully margined out, but if he had been, his story could have been much worse, a permanent loss.
So the ultimate goal, the lesson NAM finally internalized after that Friday.
It's pretty simple, really. Real success, the kind that lasts and compounds over time. It comes from profits built on knowledge, on careful preparation, on respecting risk, not from a lucky streak or reckless gambling fueled by market hype.
NAM's Black Friday, it's just such a stark reminder, isn't it? Loss is inevitable in investing. It's part of the game. But the scale of that loss, how quickly it happens, how devastating it is, that can often be managed, minimized through planning and discipline.
That's the difference right there between just getting lucky once and building a strategy that can actually endure the market's inevitable storms. It comes down to preparation.
Success doesn't belong to the luckiest. It belongs to the best prepared. NAM paid a hefty tuition fee on October 10th to learn that lesson.
He learned the hard way that finance isn't isolated. It's deeply intertwined with politics, resources, global events, everything.
Which brings us to our final thought for you today. Something to chew on as you think about your own strategy, your own portfolio resilience.
Yeah, consider this. The market is constantly reflecting global instability, often in ways we don't expect. NAM's story shows how a single social media post tied to a specific commodity policy about rare earths could trigger a massive sell-off.
So the provocative question is, what's the next rare earth? What overlooked, maybe non-financial issue bubbling under the surface today? Could it be a crisis in fresh water access, a disruption in some obscure mineral vital for next-gen batteries, a sudden geopolitical flare-up in a region we aren't watching closely?
What's the ticking time bomb that isn't currently priced into the market? The one that could cause the next cascade when we least expect it.
It's usually the risk you haven't thought about, the one you've dismissed, that ends up hurting the most.
Definitely food for thought. Thanks for joining us for this deep dive.
We'll see you next time.
All right, today we're going to talk about that razor-thin line between a lucky hot streak in investing and a smart, sustainable strategy. We're going to see exactly what happens when that line gets completely blurred by a geopolitical storm, all through the story of one investor's pretty dramatic rise and, well, his even more dramatic fall. I mean, it's the question every single investor asks themselves, right? When the numbers are all green and everything you touch just turns to gold, is that your genius at work? Or are you just riding a wave that you have absolutely no control over? Well, we're about to meet an investor who found out the hard way. Okay, so let's meet Nam. He's a brand new investor, and he is just buzzing with that kind of incredible optimism you really only find in a big bull market. It's a Friday morning, and he's feeling like he's on top of the world, just watching his portfolio hit one new high after another. And he's got a very specific goal in mind. That number on his screen, it isn't just about profit. Nope, it's the down payment on his absolute dream car, a Tesla Model 3. I mean, he can almost feel the steering wheel in his hands. So yeah, for him, the stakes are very, very real. So in the investing world, there's a term for someone like Nam. He's what you'd call an F0 investor. It's kind of slang, really, for someone who's totally new to the game, and they usually jump in when the market's just booming and it feels like you literally can't lose. And that mindset, it is absolutely key to this story. So get this. After just 1 year, Nam's success had him totally convinced he was a natural, a real Wall Street genius. His formula was super simple. Go all in, pour everything into the hottest tech stocks. Think NVIDIA, AMD, Tesla, and just wait. He truly believed that in a roaring bull market, all you had to do was just buy and you'll win. He was confident. Probably a little too confident. And this is where our story takes a massive, dramatic turn. Because while Nam was daydreaming about showing off his brand new car, a storm was gathering. A perfect storm, really, on the other side of the world, and he had absolutely no idea it was about to come and completely wipe out his dream. Now, a crisis like this, it doesn't start with a big bang. It began really quietly, with just a piece of news that seemed completely and totally irrelevant. It's the kind of headline that most of us, Nam included, would just scroll right past without a second thought. So what was the headline? It was about something called rare earths. And to Nam, that just sounded like some obscure commodity, right? Something that could never, ever affect the huge tech giants in his portfolio. I mean, sure, he kind of knew they were used in computer chips, but he just figured, it's just some distant political noise. He was dead wrong. Because this wasn't just noise, far from it. What Beijing did was critical. They basically said any product with even a tiny fraction of Chinese rare earths inside would now need an export license. And just like that, a simple resource became a full-blown geopolitical weapon aimed right at the heart of the entire global tech industry. And then the earthquake hit. And not in a press conference or some official statement. No, it came in a social media post from the President of the United States. In just a handful of words, what was a trade dispute suddenly became a direct confrontation. And all that optimism that had been powering the market for months, poof, it evaporated in an instant. For Nam, just sitting there, reading this on his phone, that was the moment his entire world just tilted on its axis. And just like that, the market reacted. And it wasn't subtle, let me tell you. It was immediate and it was absolutely brutal. That beautiful sea of green on Nam's screen, it turned into a terrifying tidal wave of red. The Dow Jones plunged nearly 880 points. Look, it's one thing to hear about a market dip, right? But seeing a number like that, it makes the panic just feel visceral, like a punch to the gut. This wasn't a correction, this was a free fall. I mean, the whole market was getting hammered, but the NASDAQ, the tech-heavy index where all of Nam's so-called can't-lose stocks were living, that got hit the absolute hardest. It plunged over 3.5%. He wasn't just in the earthquake, he was standing right at the epicenter. Think about that. An entire week of gains, all that progress, all those profits, all that excitement, completely erased, gone, in just a few hours. That dream of the Tesla, it suddenly felt like it was a million miles away. And the damage didn't just stop with the stock market. Oh no, this one event triggered a massive domino effect, a shockwave that just rippled out across all these different sectors. It really revealed just how fragile and how incredibly interconnected our global economy really is. So let's bring it back to Nam's portfolio. Here's the damage report. NVIDIA, down 5%. AMD, down a staggering 8%. And Tesla, his dream, also down 5%. Yeah, he was learning a really hard lesson. The biggest, shiniest names in tech were actually the most vulnerable hostages in this trade war. And to make things even worse, this wasn't just one crisis. It was two massive storms colliding at the exact same time. So while the US and China were locked in this escalating trade war, the US government itself was in the middle of a shutdown. This chaos at home just completely eroded investor confidence. It was like pouring gasoline on an already raging fire. And you even see it here with oil prices. Why did they fall too? Well, it's pretty simple. A trade war between the world's two biggest economies, that signals a major global slowdown. And slower growth means less demand for energy. It's just a stark reminder that a single social media post from Washington can literally change the price of a barrel of oil in London. So, okay, the dream of the Tesla was gone. His portfolio was in tatters. But what Nam gained from this incredibly painful experience? Well, it was far more valuable in the long run. So this next part is all about turning that devastating loss into a priceless education. There's a saying that a loss in the market isn't just a failure. It's the mandatory tuition you have to pay to learn the real rules of the game. The goal isn't to never lose. That's impossible. The goal is to make sure you learn something absolutely invaluable from every single loss. So what were the big lessons here? Let's break it down. First, you have to follow the macro news. Nam learned the hard way that a political headline is a financial headline. Second, diversify your portfolio. I mean, don't put all your eggs in one basket. His all-in bet on tech left him completely exposed. Third, have a clear plan. Just buy and you'll win is not a strategy. You need to know your entry point, your exit point, and most importantly, your cut-loss point before you even think about investing. Fourth, manage your emotions. Nam was driven by greed, then he was paralyzed by fear. Discipline is what saves you. And finally, number 5, stay humble and keep learning. Nam thought he was a genius, but the market is always changing, and it will remind you that you're forever a student. So Nam's story is a really powerful reminder that long-term success in this game isn't about being the luckiest investor and catching a lucky wave. It's about being the best prepared. It's about building a sturdy boat that can weather any storm that comes your way. So I'll leave you with this question. Are you prepared?